In the period 09 through 13, the Fed took the Fed funds rate to zero to fight the global financial crisis, left it there a long time, and didn't have any luck getting it back up into what you might think are normal ranges. So we had a low interest rate environment, which made life very easy for borrowers, asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history, the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world. And if you read articles about, for example, Silicon Valley Bank, they talk about the easy money environment. And the main point of sea change is we're no longer in an easy money environment.
Today, we're diving deep into a financial sea change that's rocking the foundations of investing. As we journey into this unknown territory, we'll uncover the mysteries hidden beneath the surface of this seismic shift. This is not just any minor tweak or adjustment in the financial world, but a monumental change so profound in its potential implications that it sends tremors through the pillars of traditional investing. With the financial landscape as we know it being reshaped and redefined by this phenomenon, we find ourselves standing at the brink of a new era. Truly grasp the magnitude of this revolution, it's essential to delve into the past. The last half-century in particular has been a playground for game-changing innovations. From the introduction of the internet to the rise of cryptocurrencies, each groundbreaking development has left an indelible mark on the world of finances. This sea change in investing that's currently unfolding is being compared to these pivotal moments. It's seen as a quantum leap forward, akin to the transformative echoes of the past. But what is it exactly? What constitutes this significant shift? What unseen currents are driving this sea change is more than just a buzzword or a trend. It's a paradigm shift with far-reaching implications. It's altering the very fabric of how we invest. But what exactly is this sea change, and how does it impact your approach to investing? Now let's rewind to the 1980s, a time that was characterized by a completely different economic environment than today. Picture this. The Fed funds rate stood at a staggering 20%. Truly, it was a time when interest rates were not just high, but sky high. It's hard to imagine such a scenario in today's economic landscape, but that was the reality of 1980s. Understanding the significance of this rate requires a look back at the financial landscape. Interest rates are the cost of borrowing money, and they play a significant role in dictating the pace and direction of an economy. High rates borrowing and slow economic growth, whereas low rates can encourage borrowing and spur economic activity. Fast forward to today, and the situation has turned on its head. The financial climate has undergone a complete transformation, a sea change. Today's interest rates are at historic lows, a stark contrast to the towering rates of the 1980s. This shift has major implications for our economy and financial markets. This monumental shift in interest rates wasn't just an isolated event, it represents a significant trend that has occurred over the past 40 years. We have experienced a steady decline in interest rates, which has fundamentally reshaped the financial landscape. This isn't just the opinion of one person. It is a view shared by many experts in the field, including legendary investor Howard Marks. He has stated that the decline of interest rates by a whopping 20 percentage points over the last 40 years has been the most crucial event in the financial world. The influence of this shift can be seen in every corner of the financial world, from the housing market to investment portfolios. This transformation has been monumental, and its impacts are far-reaching. It's a shift that will continue to shape the financial world in the years to come, and that's why it's so important to understand it. Marx introduces the term sea change as a profound shift in direction, an undercurrent that sweeps across the entire landscape of thought and action. He is not using this term lightly. It's not just a mere fluctuation, but a comprehensive shift in the way we approach things. Back in the year 1980, the average business was chalking up earnings per share of $1.15 on the S&P 500. Fast forward to today, and the scene has dramatically changed. Today's global corporations are posting earnings that are leaving their predecessors in the dust. The earnings per share, the S&P 500, have rocketed to an astounding $175. This isn't just a small increase, but a monumental 12-fold surge. Today, it's a whopping $175, a 12 times increase. But here's the kicker. The drop in interest rates wasn't just a mere coincidence. It was a significant event that triggered a massive shift in investment strategies. The financial world saw a paradigm shift as interest rates plummeted. This downturn significantly influenced investors' decisions. Their traditional avenues began to lose appeal. In the face of reduced returns, they were compelled to seek alternatives. This pursuit of profitable channels led them to the vibrant and promising realm of the stock market. In a bid to attain higher returns, investors began pouring their money into stocks. This influx of investments led to a surge in stock market activity. The result was a significant rise in stock prices, driving them up. Now let's fast forward to 2023. The world has spun around the sun 3 times since this moment in time, and a significant amount has changed economically. We've found at a critical junction, an inflection point of sorts that is reshaping the economic landscape as we know it. The once reassuring stability of low rates, which seemed as steady as granite, has been replaced by a volatile upward surge. This change is akin to a seismic shift, altering the very ground upon which businesses have built their financial strategies. No longer are these rates at the comforting rock-bottom levels that once fostered growth and innovation. The upward trajectory of these rates has created an unpredictable and turbulent economic environment. So, the aftermath of this change? The impact is multifold and complex. According to economic pundit Marx, enterprises might potentially face harsher climates moving forward. The inevitable tightening of financial belts will become a common scenario. The era of cheap, readily available capital seems to be vanishing in our rearview mirror. The once fields of easy money are now barren. Companies will have to adapt and overcome, finding new ways to thrive in this changing landscape. The era of easy money is behind us. Lower borrowing costs, which fueled consumer spending and business expansion, might be gone. This is a shift that could significantly alter the economic landscape. As we step into this new era, it's clear that we're navigating unknown waters. It's a scenario that no one in the investing world has faced before. It's a departure from the norm, a veer into the unfamiliar. There's a sense of uncertainty and anxiety, but also anticipation and curiosity. This is a game changer. The rules of the game are evolving. We are venturing into a new phase where old strategies may no longer work, and for investors this means a need to adapt. So, what's your strategy in this changing landscape? With rapidly evolving international markets and fluctuating economic trends, how are you investing your resources? If you are a passive investor, you might argue that the market inherently grows in tandem with the economy, so why change anything? However, if you are an investor, constantly moving and reallocating your investments based on market trends, then this shifting landscape could be an enticing playground full of opportunities. The volatile markets may not be a hurdle, but a chance to explore untapped potentials. But for those actively allocating capital, there are new choices. Marx suggests looking beyond conventional stock investments, urging investors to broaden their horizons and consider other viable options. One such viable option that he highlights is corporate bonds. According to him, this financial instrument could be a game changer for many due to its potential. They could offer returns that are comparative to stocks, but the risk involved could be significantly less. However, it's not just about blindly diving into bonds. A proper understanding and expertise in analyzing these investments becomes crucial. It's a shift from the norm, and it may be an opportunity worth exploring. Investing, in essence, is about understanding and gauging human reactions. It's about examining how people, as rational and irrational beings, respond to various economic events and market fluctuations. The market, its raw, unfiltered form, is profoundly influenced by how people perceive and respond to an array of events. Thus, Howard Marks not only hits the nail on the head, but he also drives it firmly into the woodwork, leaving no room for doubt.